money but too busy to start a side hustle? Do it the right way and teach your money to make more money for yourself, even when you're asleep. Dale Corpus will show you just how here on the School of Cash Flow. With his entrepreneurial mindset and extensive experience in real estate and finance, Dale will help you become a responsible, strategic, and passionate passive real estate investor. Learn how you can increase your earnings or find more ways to make money, only here on the School of Cash Flow.
Hey everybody, good afternoon and welcome to the School of Cash Flow. So I'm the host, Dale Corpus, and this is my first episode of my new podcast career. I'm so excited to launch this new venture. So I've always wanted to do this because I get to share things that I already invested in the real estate space to build cash flow, build equity, and that generational wealth. They've always been important goals of mine. And now with this podcast, I have the platform to highlight different syndicators, operators, and specialists in different areas of real estate investing to empower you to invest in real estate passively as you're busy doing your day-to-day thing. And I'm a huge fan of passive real estate investing because for those of you that may or may not know, I'm already busy running a busy real estate sales business and a real estate sales team. So I stay in my own lane, just, growing that, and also being a good father and husband for my wife and kids. And I do what I do best, which is stay in my lane, growing and making enough money in real estate sales to create enough income so that I can invest passively with other experienced operators that are best in class with what they do to really create this passive, income cash flow. So if you're wanting to grow your portfolio and cash flow through real estate investing, you've come to the right place. So speaking of asset classes and investment partners that I already work with, on this inaugural episode, my guest today is Chris Seveney from 7E Investments, and his specialty is note investing, which happens to be one of the investment types that I have a good amount of my retirement account portfolio in. It's a really exciting topic, and it might be new to some of you as well, which is fine. And Chris is someone I actually invest in as well, as he operates his own mortgage note funds, and I've invested in a few of them already. A little bit more about him is that Chris shares his note investing knowledge in first position in performing and non-performing notes with his peers. He has an intimate understanding of this niche industry from his continued effort for self-improvement. Chris received his bachelor's degree in civil engineering from Worcester Polytechnic Institute and is now furthering his studies by being enrolled in the master's in real estate finance from Georgetown University. Chris has been able to build his note investing portfolio to over $5 million and his overall real estate portfolio to over 7 million. So Chris, what an honor to have you in my first episode. How are you?
Good, Dale. Thanks for having me on your first episode. I'm excited to be here. As you know, I could talk for weeks about notes or other types of real estate investing because, I come from a real estate background and I enjoy these types of conversations and happy to be here and thoroughly enjoy, working with you in the past and continuing that venture here on your podcast.
Well, thank you so much. I know that, you're a busy guy, and I did mention a little bit about you in that intro. Is there anything else that I missed or anything that you wanted to add?
Yeah, I'll just, add a little difference. You stay in the lane with your full-time job and family. I kind of swerve outside the lanes because I do have a full-time job in commercial real estate where in the Washington, D.C. area, where I oversee development construction for a local D.C. based developer. I've been in commercial real estate for over 20 years after I got my civil engineering degree. And, 5 years ago, I started getting in notes. 8 years ago, I started building my own personal portfolio with some rentals and other types of real estate asset classes. And then it was impossible to scale that business, especially in the DC area, similar to, where you are out in the, Northern California. It's extremely, cost prohibitive to try and scale. You need to have very deep pockets, similar to DC. And, note investing was something I stumbled upon, honestly, because like you mentioned early on, people don't even know about this, or most people don't know about this investment avenue that people can take. And once I got into it, I got hooked. And now I've gotten a portfolio of close to 300 notes now that manage and through several different funds. And I love it. So,
yeah. Well, let's start about that. I know a lot of people that are listening right now might not even know what notes are. I mean, I've been involved in it in the last maybe 6-7 years myself. So let's just, let's get to the chase and cover that. What is note investing?
Yeah. So yeah, exactly. So note investing, so we invest in first position residential liens. So people who buy houses typically get a mortgage. And when you get a mortgage, most people don't understand there's a difference between a note and a mortgage. The note is the IOU, meaning you're borrowing $500,000 from the bank. You'll sign a note that says you owe the $500,000. The mortgage is the document that attaches the note that says, oh, by the way, if you don't pay on your loan, that it's securitized by that piece of property. And that's what the mortgage is, the ball and chain that takes the property and connects it to the note. So what happens in note investing is if borrowers might be slow paying or they default, banks typically don't like to hold that paper. So what they'll do is they'll sell it off to funds, which make their way down to investors like myself, and it gets sold at discounts. So, you can buy notes at a discount from anywhere from, on average, you're typically between 40 and 60 cents on the dollar on something that's not paying. Sometimes you might pay higher or lower, but that's somewhere in that price point. But that's really what note investing is you're buying a bad mortgage, similar to like in real estate investing where you're buying a fix and flipper. You're trying to fix it up where we're trying to fix the borrower to get them paying again, and then eventually turn around and sell it or collect that cash flow.
Okay, got it. So it makes sense. So you're really investing, you don't own the house, but you're investing in, the debt on the house, right?
Exactly. And that's the one thing the first thing people think of is you're buying the house. No, you're not. You're basically becoming, I'll use these banks, as for reference, because everyone knows PNC or Wells Fargo. Instead of you borrowing the money from Wells Fargo, you may have borrowed it from Wells Fargo, but Wells Fargo sold your debt to me. So now I am basically the bank in that instance where now you owe me the money.
Okay. Not a bad thing to be the bank.
No, when you go to every major city, who typically owns the tallest building in that city?
Good point. I'm glad I know.
Insurance company.
So how did you get started in note investing?
Yep. So I got started, like I said, I stumbled upon it because we were trying to scale real estate in our area, and we'd get a listing come on the market or off market listing. And I've got a wife and kids and, sports and everything else. If you're not there like that day to go look at it and putting in offers, it's gone. So there was no way to scale. And I'm not going to be driving around the state of Virginia or the Maryland or DC trying to find these properties. So I found on BiggerPockets note investing. And I was like, wow, you can do this from anywhere as long as you have an internet connection at any time during the day. And if you're really strong management skills, which I have from my construction management background and my commercial real estate, you can really thrive in this business because that's pretty much what we do is we just manage vendors.
Makes sense.
So that's kind of how I stumbled upon it. And, once it took me about 6 months of education in this space. And then I pulled the trigger with some of my retirement funds to buy some of my first assets.
Mm-hmm. And question, you talked about performing notes and non-performing notes. So non-performing notes are the ones where someone is not paying, on the mortgage. So how do you make money off a loan where someone's not paying?
Great question. It's, and again, I'll go back to the analogy of buying a vacant property that's dilapidated. You got to put work into it and try and get it fixed up and, rehabbed in that sense. In this sense, instead of you're rehabbing a property, first thing we always try and do is we try and work with the borrower. We try and rehab that borrower to get them on some type of payment plan that makes sense for all parties. And what we found in a lot of instances is people who are in that property and been there a long time, they do want to stay. Yeah. And it's just coming to some agreement, because what happens a lot of times is if you miss a payment, and all of a sudden you're 3 payments behind, the bank will want all 3 of those payments at once. and they keep accumulating fees. So it's just exponentially growing for what is owed. And the people just get so far behind, there's nothing, and the banks typically don't want to deal with these people, so they'll just ignore them. So it just it's almost like if you've ever dealt with short sales. I'm sure, you want to rip your hair out trying to deal with a bank on a short sale. Delinquent debt's the same thing. But when we buy it, we can put more attention to it, but we try and first modify the borrower, get them on a modification where they give us some type of down payment, and we may move payments to the end of the loan. We can shuffle and work the numbers to make the numbers work as long as they can afford it. Mm-hmm. If they just don't want the property or they're non-responsive, then we may have to go down that path of foreclosing on the property. And that's where, when you're buying it at a discount, you want to make sure there's enough meat on the bone, as they say, that, if you have to foreclose, there's still a spread in there that you're buying it plus all your legal costs, still gives you ample opportunity to sell it at foreclosure if you have to and make a profit.
Okay. That all makes sense to me. What are the challenges in this space?
Oh, we don't have time to talk about all of them.
What jumps out at you?
Yeah.
What jumps out at you?
So the biggest challenges that I've had, or I see, is communication, like in any business, in setting expectations. And what I mean by that is, you deal a lot with attorneys, right? And attorneys are not all the same. There's some really good attorneys, and there's some attorneys that are not as good. But also, you got to be focused on, for like somebody like me, I'm not a major player. So, it's like any business. With an attorney, they have a big client, they're probably going to have preference over you. So sometimes your stuff may slide a little bit, and you just have to understand that. And a lot of people think it's a me world, and I want to be first. There's no other, investors or nobody else that you should be taking care of. So that's the first, is just dealing with attorneys and making sure you vet them, because I've done some work with attorneys who, honestly, it was not a pleasant experience. The other is, you also have loan servicers. So I don't physically pick up the phone, call the borrowers, collect the money. We use a licensed third-party company that does that.
Yeah.
And, they're really a call center. They're, a debt collection call center. So again, they basically have a script that they follow, and they don't think outside the box. So it's very sometimes challenging to get them to, like, oh, why didn't you ask this question when you had the borrower on the phone or whatnot? So sometimes there's a lot of frustration there, because sometimes you're almost left with them as the middleman trying to relay the information, and things that seem like they could take a few hours take several days to have that work done. So it's a lot of juggling and a lot of management in just dealing with people, which, as you know, Dale, in any business, it's doing your work isn't the hard part or getting things done. It's managing people is always the most challenging part of any business.
No, absolutely. Absolutely. It sounds like, but you got a good grasp of how, what to expect of who you're working with, especially you work with many vendors, I take it, and multiple servicers.
Yep. Yeah. And again, it's communication, understanding the contracts, and just setting the expectations and letting them know what you expect of them and what they expect of you, because it is, it's a two-way street. It's not one way, it's two ways where you got to work together.
Different question. How do you personally find assets to acquire?
So, fortunately, because I've been around for several years now, I've built a lot of good relationships with some of the larger funds who sell assets, and I've built a good reputation, because this is a really small industry. I mean, it is really small. And if you don't have a good reputation, people will know. And there's some people in this space who do not have a good reputation, and it's well known. So that is one. And it's really just doing to get that, just doing what you say you're going to do. You don't ghost people. If you're working on a deal and something happened where maybe you had some funding that you lost, you just call the person and say, hey, look, I lost my funding. I'm sorry, or give me another week. But if somebody else jumps in line, sometimes that stuff happens. You just, again, goes back to what I mentioned 2 minutes ago, communicate with these people. Now, getting started in this space, for people who do get started, there's websites like like Paper Stack and some of these other brokers or servicing companies who put out assets for sale that you can buy from. And that's where I typically recommend people start, just to get your feet wet so you can start building up that reputation. Because if you haven't bought notes before, trying to go buy them from somebody who usually is selling 1 million at a time, they're going to want to kind of know you're legit and not wasting their time. So they're going to probably call around and talk to some other people. Hey, who is this person? And so forth. And it's like I said, it's a small business where they'll ask you a few questions. They can tell just by asking the questions how long you've been around in the space.
Okay, that makes sense. So for someone that's first starting off, or even from when you first started off, did you start off with just individual notes? Did you start off with funds? Tell me more.
Yeah, I started off with notes using my own personal money. That's what I always recommend is, put your own skin in the game first before taking someone else's money, because you're going to make mistakes. And for me, and I always recommend people, you make mistakes with your money, not someone else's. So I bought 4 notes in my first go around. Typically most people buy 1 or 2. I bought 4. They're very low balance. These have balances of like $5,000 to $10,000 on them. I think I paid 25 grand for these 4 assets. One was performing, like one was in bankrupt, 1 or 2 were in bankruptcy, and 1 or 2 were non-performing. So I wanted to kind of get a flavor of, how it was like. And it was a huge learning curve and experience, because it's, probably similar to you selling real estate. They can teach you everything in a book, but the moment you have to actually deal with people and interact and go through the process, there's no book that can teach you every single little insider trick and so forth, or what goes on. And the same thing with notes. So for people, I would recommend, if there was one recommendation with somebody just starting out, what I would just tell them is buy a small performing loan with equity in it, just to learn the processes and the steps of going through getting it to the servicer and, buying that loan and managing it.
Makes sense. What type of background do you need to start doing this stuff?
I mean, people from all facets of life, get involved in note investing. I know some people who, come from backgrounds of auto mechanics, truck drivers who are successful note investors. I come from a, real estate side of things, and I feel like I've done well. I find people from the finance side typically do better. Finance or real estate, because one of the key aspects of it is understanding how to value an asset, but also understanding the time value of money, which is a finance component, and also portfolio management. So a lot of finance people have that portfolio management, because buying 1 note versus buying 50, it's a very different aspect of thing. It's like buying 1 stock versus trying to buy 50 stocks. You want to make sure from a correlation standpoint, what's correlated, what's not, to try and really give you a blended portfolio to try and maximize your profits while also minimizing your risk. And that's probably the most challenging thing with funds, is understanding that mix to try and maximize profit and minimizing that risk.
Got it. You had mentioned when you first started off in notes that I think you were dabbling with your retirement account.
Yes.
So regarding that, are you mainly buying these notes inside your retirement account or outside your retirement account?
So for my own personal notes, most of them I buy with my retirement account. And the reason why is, and this, Dale, note investing, unfortunately, compared to traditional real estate, doesn't have tax benefits. You're not owning the property, so there's no depreciation. So if you're using, I'll call it after-tax money, you're paying ordinary income on those funds. So that's one of the downsides of note investing. Now with some legislation that they're proposing about getting rid of capital gains, that for me, I saw that, I'm like, wow, that actually opens up a lot more investors for me, because most of my investors use passive money for note investing, and they're after cash for other syndications in real estate, which honestly I do too. So I can't blame people for that. So yeah, that's one of the reasons why you see a lot of IRA and solo 401k investors, because when you're using that retirement account, if you're investing in a regular traditional called multifamily syndication, you don't get the benefits of the depreciation and those benefits. Whereas in notes, you're getting, if you've got 2 buckets of money, I would tell people after cash, after tax for syndications of multifamily or other real estate, and your IRA money, I'd put that bucket into notes because, from how the taxes work.
Absolutely. And the funny thing is, the only way I know about notes too is when I was learning about self-directed IRAs, and I realized that notes could be purchased with them and that they were taxed. It made sense to buy them with them because of the fact that it didn't have tax advantages, buying outside my IRA, just like you're talking. That's how I stumbled upon note investing myself. And it's been an amazing ride. Wanted to ask you, what's been your biggest mistake in note investing so far?
So I'm from the Northeast.
Okay.
So, typically we are very aggressive. We're very passionate, and sometimes we make our decisions based on how we feel at the moment versus common sense, or stepping back and thinking about it logically. That's typically when I found if I make a mistake, it's almost like I don't want to use the term vindictive, but it's like when you're dealing with a borrower who hasn't paid in years. Basically, do you cut off your nose to spite your face? Like sometimes you have to pay them money to get, to basically exit this deal in some fashion that benefits you. But, in the same token, you spent countless hours, countless dollars with attorneys trying to get to some conclusion. And then at the end, it's like, you got to pay them. It's like, are you kidding me? But when you look at it, sometimes, that lowers your risk and gives you probably sometimes the most profitable exit strategy. So sometimes I've made decisions based off emotion versus making them, based off of, stepping back and, common sense.
Makes sense. You mentioned exit strategies. So with notes, can you talk a little bit about the different types of exit strategies that are available?
Yeah. So this is one of the things, another reason why I love notes and why sometimes it, from a risk perspective, I view it as sometimes having lower risk than buying a property to rehab and then trying to sell it. Because, in those instances, a lot of times people may get hard money and they go rehab it and then they're forced to sell it. Or they may have to refinance, turn it in rental, but that's very challenging process sometimes. As a note holder, again, you're at the top of the food chain. So if it's non-performing loan, you have the foreclosure route, that you could foreclose on the property. Then if you do foreclose, then you have the option of selling it. You could rent it, but you could also sell it with owner financing because that's what you do. So I do that a lot as well, is I'll sell it and sell it with owner financing because sometimes some of these houses might be houses in areas where it's a $50,000 or $75,000 house, which where you're from and I'm from, you can't get, a parking space for that price. So sometimes banks won't lend on that, and we can be we're still a bank. We'll be the bank and lend on that. So that's, one option strategy. But sometimes if the borrower doesn't want the house, we'll try and short sell it with them. And it's not all that red tape when they ask. It's like, if you call me, I can make a decision in 10 minutes on a short sale, not 10 months. Again, you can try and work it out with that borrower to get them on a repayment plan as well. So that's, a strategy that if you do get them paying, you can sell it as a performing note. You can also do what's called sell a partial, which is an advanced strategy where if a borrower has 100 payments left, I can say, hey, Dale, I'll sell you 50 payments of that loan. And that, because it was non-performing, I got a discount. They've been paying a few years. Hey, Dale, you'll buy 50 payments. You're probably giving me back what I have into it. And now I just deferred 4 years from now, I'm going to get cash flow that basically cost me nothing because I got my basis back. There's just so many different aspects. Like I said, you could sell the note. I've done things where I've sold the property and carried a second note on the property in some instances. So people talk usually about 8 exit strategies. I can probably come up with about 20. But when you think of conventional real estate, basically because you've got a loan, you're either renting it or selling it from that perspective, as a lender, it just opens you up to so many more opportunities.
Yeah. So no, it really, puts you in a better position where you could really balance out that risk, So
it's much more flexible. There's a lot more flexibility is what I would say, even in a market that's, headed, say it was a decade ago and the market was, heading south quickly, and you're the lender. If you took it back, your cost basis is, probably, it's probably pretty low. So maybe you turn it into a rental to wait till the market turns. But also because your financing criteria, ability to repay, can be a little different than, Fannie and Freddie or a traditional bank. You could, still have certain requirements you have to meet, but you could also turn around and own or finance it to somebody that may have already had to short sell a house, but it was more because of a job relocation and the housing price stock dropped or something along those lines. So, credit scores, are something we can kind of push aside. It's really more, can you afford the house or not?
Are there certain states that are better than others to invest in notes?
Yes. But also it's like anything, you're going to pay for those states as well. I'd say the premier state that I think people put on their number one list is Texas. Because of the size of the state. Okay. Second, there's a very wide range of house pricing in Texas. And the last is it's non-judicial, meaning you don't have to go through the courts to foreclose. Okay. And you can foreclose in Texas in I think 75 days. Whereas if you look at New York, for example, New York, you're more at 75 months. So, wow. So it's very state specific, but in the same token, if you took two notes that were exactly the same, let's just say they were exact same home price, number of months past due, everything, and one was in Texas and the other one was in New York, that New York asset, you would pay probably 30 to 50% of what you would pay on it if it was in Texas. Mm-hmm. So you're buying it at a much lower price. So some people would say, because you're getting it so low, your risk profile now is probably lower because it's more of a discount on that asset compared to paying a premium in Texas, where if something goes wrong, your risk profile is higher in some instances.
Uh-huh. In terms of the size, the loan sizes that you tend to go for, mm-hmm. What loan balances or what do you look for when you're looking for notes investing?
Yeah, most of my balances are under 100 to 150,000. Okay. And it's been a sweet spot I've found. And the reason why is a lot of these funds that I buy from, they'll buy, say, 1,000 loans at a time. Okay. And they only have staff to maybe manage, say, 500 of them. Now, it costs the same to manage and foreclose on $1 million note as it does a $100,000 note. Okay. And if you're trying to peg a 20% profit on each one, $1 million note, you're trying to profit 200 grand on, where the other one you're profiting 20 grand. Which ones do you think they're going to hold and spend their time on? And which ones do you think they're going to want to sell? Of course, they're holding the big ones, selling the lower value ones. And part of their problem is, just like a large company, they have too much overhead to manage those. I'm a smaller company where I think I manage very well. So I have lower overhead, so I can take on those loans and manage them. And I'm not opposed to making $20,000 on an asset versus, them $20,000 might, great. They made that, but okay, it pays for their office space for the month. So it's really a niche that I've found, that price point of, those loans under 150,000, because I find good supply of those and I can still make decent returns on them because I'm basically taking ones that don't fit their profile.
Okay. And what advice do you have for someone that wants to enter into this space?
Advice I'll give to anybody entering into any type of real estate space: do your due diligence on everything in the space. From training courses to meetup groups to the people who you associate with. Just because what I found is, people would refer people and be like, hey, yeah, go to this person or that person. But what I found is they've never actually used them. They heard them from somebody else who heard them from somebody else who heard it from somebody else, because the person put a Facebook ad up about something. And that's how people hear their name. So just because somebody is a absolute awesome marketing genius doesn't mean they know how to run a business. And just like other aspects of real estate, I'm sure you've seen it. Right. There's a lot of, you read about it all the time in newspapers of this person went out and raised all this money and then ran off with it. And now people are left holding the bag. So that's really the one thing I tell people, even when people like look to invest in my funds, I'm like, do a skip trace on me, do a background check, make sure you just, the reason I tell that is I know it's coming back clean, but I want them doing it on every single person.
You're training them. Yeah. You're basically training
them too, because, when you're giving somebody $100,250,000, that's a lot of money. I don't care how much money you have. That's a lot. And, I can just imagine, I tell people, if I had to go to my wife and go walk up those stairs and say, yeah, hon, I invested $100,000 with somebody, and it wasn't because of the deal went bad. It was because they went bad. Right. I might as well, go out into the shed and just, put an inflatable mattress out there and put an air conditioning in it, because I'm going to be there for a long time.
What are the biggest mistakes that you see, people in general make?
So, the two biggest mistakes I see people in this space make are buying too early. And, the two analogies I'll have is, so I've got a civil engineering degree. Okay. So I went to college to basically, let's say, design concrete and bridges and stuff. After my first 3 months, I took a course on, how to design a bridge. I knew enough to get myself in trouble, but could I go build that bridge or design a bridge? Hell no. It's the same thing kind of like or with a note business. Just because you spent a few months training on something, stuff, but do you know enough to run a business? Not at that time. It takes time, effort, networking. So I always tell people, you'll want to spend, 6 months just learning the ropes and understanding things, or if you jump in, like I said, buy that performing note, because one thing I see people do is they jump in too early and then they realize they overpaid. I was on Facebook last night. Somebody posted a note that they wanted for sale. They wanted 85 cents on the dollar on a non-performing loan in a tough state. And I joked and I said, that loan's worth about a third of what you want. She's like, yeah, I know, but I paid a lot more for it, so I don't know what to do. I'm like, well, got to take the loss. So that's one. The second thing I see is people trying to inflate what they know to raise money too early. And like I said, it's okay to use some of your own funds to test things out and, run with it. And if you want to start a little earlier with your own funds, great. But when I see people after, taking a course over a weekend or a week-long session out there trying to raise money for people and say, hey, I'll invest it for you, that scares me. From that perspective, it goes back to what I mentioned a minute ago about doing the due diligence on people. How many deals have you done? How many deals have you closed? Who do you have for references that you've done deals with?
Got it. How did you gain that confidence? What was that path from when you started doing individual notes to now managing funds?
Yeah, it was a long road. It took... I'll briefly talk about things because it set some expectations too. Yeah. So I bought my first note late 2016, and it was those 4 assets. So basically 2017, I had lost my father early in the year as well. So I, basically had a lot going on, but I was working those 4 notes, and I bought probably another 6 to 10 notes that year. And I started working on them. Some of it closed out. And then towards the end of that year, I started doing a few JV deals with people where they would fund the deal. It was one-on-one, one asset, fund the deal. I will go manage it. So my first year, I didn't make really any money because, a note takes about 18 months to work everything out. I started doing these JV deals, and then 2018, I started doing a few more. And then, as I started, making some money and started building credibility for myself and like, yes, I know what I'm doing. Started getting more investors involved. And then funny thing is early 2019, I had probably at the time like 20 JV partners, and it becomes each JV partner is like a business. So you have to reporting and everything. It's challenging. So I told my attorney, I said, okay, bite the bullet, start putting fund documents together. So he put them together that spring, and then an opportunity came that summer where a seller had it was like 90 assets for sale at a killer price, probably 30%, it was, I paid like 40 cents on the dollar for the entire pool, which should have probably sold for like 60 cents on the dollar. So it was, but all of a sudden it was, like an $800,000 acquisition. Right. So I literally and I'm like, okay, I have to put these in a fund. I had the fund already drawn. I literally went out and raised, at the help of with Gail Greenberg, we went out and re-raised the money in a week. It was crazy. It was
got thrown into it. Yeah.
It was like, back in college, like cramming for finals, like, that's what I felt like. We did it. And then, but the reason I got into the funds is because, if you have 20 investors in a fund, it's one reporting. It's the same reports to 20 people versus 20 deals. So it's just a level of how much you can scale. And then what I started to do was, for my funds, I kept them low dollar, around the $1 million range. And the reason I did that is because on my first fund, it went very well. We're wrapping it up this year. But there's still things you'd like to improve upon. So every time I'd open a new fund, I would tweak things and improve them. And I try actually some things that were a little different on my end about like what types of returns I give to see, okay, what is that sweet spot of keeps me happy, keeps the investors happy. One fund, honestly, I gave out too much to the investors. And then that investor comes to me in my other funds is, why aren't you giving this out? I'm like, because I honestly, just being honest with you, I gave you too much in that other fund. And I said, go look at these 5 other note funds where people have, and you'll know that I was very kind to you in this one. But that's the one thing I do want to mention too about note funds. You can't compare them to a multifamily syndication, because multifamily, you've got property management fees and all these other fees and stuff, and sponsor fees and acquisition fees. And so when people look at note funds for the returns and so forth, especially any excess distribution profit split, it's very different from multifamily. And people think that it's like, oh, it's really low. But on a multifamily deal, you're like 7 years out. These are 3 years out. And, at the end of the day, the returns on the yield perspective are pretty similar. They might be a few points lower, but also from a risk perspective, I view it as less risk.
I get it. Like, so nowadays, moving forward, do you prefer like the fund model, or are you still seeking out individual notes at all?
I do not do any more joint ventures. I actually bought out probably 95% of my joint ventures. I have, I think, like 2 or 3 left. And of one of them is somebody who was like my first investor. So it was almost like, okay, I'm not gonna buy you out because you kind of helped me get started. But yeah, so I basically started buying them out or selling the assets, or some of them I sold back to that investor and basically said, you can keep all the profit. I just didn't have the time. And so my model now is strictly just running everything through multiple different funds. Yeah. So what I found is there's different types of investors, some, from a risk profile perspective. So I've created products that fit every single type of investor in my mind.
Let's talk about that. What's your typical investor profile? Like, what's your your ideal investor avatar?
Yeah. So, I find most of the investors are IRA fund investors. I mean, using funds from their IRAs for probably 80% of the investors. Most of them are people like yourself, Dale. Hardworking, high earning career, spend a lot of time down to 9 to 5, but also family, and they don't have time to take on another avenue or another venture in that sense. So that's typically where I see investors start. Invest in notes, and again, diversified, understand real estate, try and understand a little bit about the note space. And that's my preference, is they understand a little bit, because when the more they understand, the better it is and easier for me to communicate and make sure they understand everything. And most investors, honestly, like any syndication, typically they'll start off with a lower amount in the first fund. And then once they realize, hey, this is actually pretty cool, as I start to open more, next time, the fund that they may have had 50,000 for, magically $100,000 appears in their back pocket that they can now invest because they realize, it is a interesting investment strategy if you're good at what you do.
Yep. Makes sense. How does somebody invest with you, by the way?
Well, how they reach me or the different avenues that they invest in?
Yes, both, actually.
Yeah. So, we've got kind of the way I've structured it, kind of like you mentioned, the avatars. So I kind of view there's three different avatars from the risk profile. We'll sell partials to investors, which are, Dale, you're going to buy 50 payments and of a loan where your investment is, there's no more out-of-pocket expenses for you. If the loan, it's a performing loan that if we're to default, I manage it, comes out of my pocket, and you get 50 payments of principal and interest over the next 50 months. Very simple. So you're getting your principal and interest back. So every month your risk continues to get lower. Loan to your investment to value is typically about 30%. So again, from a risk perspective, this is probably in my mind, looking at it on paper, would be the lowest risk. Next is I have a performing note fund, which is only performing notes. And that is investors can invest 12 months is the minimum. After 12 months, you can take your money out. So sometimes people will be like, I'm skeptical of the stock market. I want to put money away for 12 months and collect a return where you get interest payments every month, or you can just reinvest those dividends. Is another option for investors as well. Again, that would move next up on the food chain from a risk because you're only getting interest back every month compared to the partial where you're getting some principal. And then the third option is our non-performing note funds, which is where we invest in performing and non-performing. It's leaned more towards non-performing. Yeah. Of course, that provides the highest return, proposed highest return, projected highest return to investors, where we try and target 11 to 15%. Typically we'll give prefs in mid to high single digits with excess distributions on top to kind of get them to that level. And we typically run those for about 36 months.
With what you just described, was there a minimum investment amount?
Typically 25 grand is what we have. I know other syndications, you'll see people want 100 or 250,000, but we try and keep it a little lower for people just because most people are newer to notes and don't understand notes. So, if our minimum was $250,000, I think we'd be pushing a lot of people outside that comfortability level because that's the biggest thing with us. We want to make sure you as the investor are comfortable. We're completely transparent. One of the things that separates us from other funds that I believe, especially note funds, is you're not investing in a black hole. We provide people a portal where they can see every note that's in that fund, what's going on with that note. They get to see my comments that I put in when I manage these loans or our partners are managing these loans. So people get to feel more involved from that perspective versus, and again, this isn't a knock about any other funds, but a lot of other funds, it's you put your money in and it's like, okay, I get a return statement, but what are you investing in?
Yeah, just because I invest with you already, I love the transparency and the open communication and the fact that you're accessible. That's a huge thing for me.
Yeah.
I think to a lot of people, give people that comfort level. You know what I mean?
And I'll be honest, I'm busy, and at times people reach out to me and it'll take me a week to get back. And I feel guilty sometimes that it takes me that long. And, usually what I do is at least try and shoot them an email. But one of the things I tell people is I have a Calendly link with a calendar that I give every investor. And I'm like, the best thing to do is if you want to really get me is just schedule it, because if you call me during the day or call me, I'm probably in the middle of something. And, I am one of those, I'm a David Allen GTD, getting things done type of person where I'm laser focused on what my tasks are. So I, like to stay on that path. And if people are just calling me and disrupting me, it's kind of like, nope, not right now. I'm sorry, I'm busy, but I'll get back to you, or, schedule an appointment with me. But I make it a purpose or intention to try and get back to people, answer their questions. And like I said, be as transparent as possible.
Love it. Does somebody have to be an accredited investor to invest with you?
So in my funds, yes. Now, once in a while, we open funds for not accredited investors, which of course we can't advertise. But that's where, that's where you just build relationships and network with people. So when the opportunity exists, with our partials though, you don't have to be accredited. So that's the one difference with our partial investments. So that's where I left that open as well for investors from that perspective. And those also, from a dollar perspective, we have partials that minimum, starts with like a $10,000 minimum as well. So it's just, again, another avenue to try and fill that profile, because there's investors out there who want to get in notes, want to be involved, but also not have to manage that perspective of it. So, we put them in that partial program.
Makes sense. I mean, you have everything for folks in different, stages and different levels. I love it. Mm-hmm. How can someone learn about you and your company?
Yep. So, they can go to our website, which is 7einvestments.com, and it's the number 7, the letter E, then the word investments.com, which I'm sure, Pot of Ties will put in the show notes for you. Also, I do, a little self-promote, have a podcast called the Good Deeds Note Investing Podcast, where, it's interesting. We share our stories of just all the crazy stuff that goes on in this business. It's really interesting. And it started with conversations I had with another note investor when I was driving out from my office on my full-time job. I was leaving work and I was just calling them, and we were just venting about these crazy stories. And we joked and we're like, okay, we got to start recording this, because this is gold. And it was. I mean, people really latch on, because one of the things about me is, I'll say I'm a horrible marketer in some sense, because I'm not a sales guy. I really don't sell anything. I'm more the anti-sales guy, where I try and tell people what it's really like, like you sell homes. So, what it's like to really, buy a home or something is, it's not all, rainbows and unicorns sometimes, especially certain houses, and so forth. And same thing with notes. I try and tell people be real, because there's a lot of people out there who they sell a dream or they sell a story that is just so far-fetched. Like, you can make 6 figures in your first year in note investing. Well, yeah, you can if you got like $5 million, but people starting out with 50,000, it's not happening. Name any investment you can put 50,000 and make 100, unless you hit Bitcoin at the right time, or, some crypto. But, again, look at the risk you're playing with that. And also, again, the same thing about learning in this business is, it takes time. It's not something you can learn over a weekend. So, that's one thing where I've kind of built a little bit of a reputation as being somebody who helps investors from that standpoint as well. So I digress and talk a lot, but I apologize for that.
No, I love it. It's like, well, you just brought a wealth of knowledge to all these listeners right now. I appreciate you, Chris, for coming on this episode. So thank you for your time and again providing all this value. And to my listeners, thank you for checking out this episode of the School of Cash Flow. You got to check out Chris's podcast as well. Chris, what's the name of your podcast again?
The Good Deeds Note Investing Podcast.
Okay. Thanks again, Chris, and see you guys. Until next time, live life abundantly.
Thanks for listening to another episode of the School of Cash Flow. We hope you enjoyed our deep dive into all the tips and tricks you can use to help you on your passive investing journey. In the meantime, you may visit www.cashflowschoolpodcast.com for more great episodes. Don't forget to subscribe, rate, review, and share. That's all for this episode, folks. See you next time.